In our earlier video, we analyzed the historical market reaction following monetary policy announcements. That was a historical review of what followed specific policy events. Today, we are zooming out to look at country-level reserve strategy. The data presents us with a specific question. In the first 3 months of the year, official institutions reported massive accumulation. This happened even though spot values were already reaching new highs. For a retail trader, this looks like buying into the peak of a bidding war. Conventional trading logic usually suggests waiting for a market correction or a lower entry point. Central banks operate under a different strategic framework. They are reserve managers responsible for national wealth over decades, which means they are not trying to time the market for a quick profit. As this diagram shows, a sovereign reserve toolbox contains a mix of foreign currencies, sovereign bonds, and physical gold. Each asset serves a different purpose for a nation's balance sheet. To understand why banks buy gold at any price, we have to define counterparty risk. Assets like sovereign bonds or foreign currencies are essentially promises from an issuer. Their value depends on that issuer remaining solvent and keeping their word. Physical gold is different because it is not an IOU. As highlighted here, it carries no counterparty risk. It relies on no issuer or foreign government to maintain its value, making it a distinct type of reserve asset. In an unpredictable geopolitical climate, holding an asset that does not depend on a counterparty's promise is a defensive strategy. Central banks are willing to pay a premium for that structural independence. These cards show the scale of recent demand. In 2025, central banks reported 863.3 tons of net gold demand. While this was lower than the record-breaking years of 2022 through 2024, it is still nearly double the average seen between 2010 and 2021. There is a significant data visibility note. The World Gold Council estimated that more than half of the annual volume last year fell into this category. Many nations acquire their reserves through private bilateral markets or specialized state-owned financial entities. This means the official figures often lag behind the actual accumulation happening in the market. While the global total provides the macro scale, the country-level data shows how that demand is actually distributed. This bar chart shows the 2025 reported additions. These countries are not acting as a unified group. They are executing domestic strategies based on their individual economic needs. Poland is a clear example of a reserve builder. After adding 102 tons in 2025, they continued through early 2026 to reach 595 tons. Their accumulation is guided by a specific, publicly announced long-term goal. This highlights tons versus reserve share. China is a steady accumulator, holding 2,322 tons, but it represents only 9% of their total reserves. Uzbekistan holds fewer tons, around 414 to 416, but it makes up nearly 88% of their national reserves. Absolute tonnage measures a country's market impact, but the reserve share shows the role gold plays in their strategic financial stability. In the first quarter of 2026, the data shows this trend is widespread. Alongside the largest buyers, smaller regional economies like Malaysia and the UAE also reported additions to their reserves. April 2026 activity shows central bank demand is not a one-way street. Global net buying was 19 tons, but individual moves were mixed. While Poland and China added gold, Russia and Uzbekistan reported reductions. This highlights an actively managed ecosystem where nations trim positions. India represents a stability case. Following market rumors of liquidation, the central institution confirmed their holdings remained entirely unchanged. Choosing to hold steady while gold prices fluctuated between 4,100 and 5,500 shows the discipline of these managers. They are prioritizing long-term stability over reacting to short-term price moves. To understand market impact, look at gold's price history. The top row shows a 65.95% jump in 2025. In Q1 2026, despite 244 tons of central bank demand, the price ended just 2.45% higher, moving through a wide range between 4,100 and 5,600. This shows that sovereign demand does not dictate immediate weekly moves in the spot market. Institutional accumulation provides vital context for the global financial system, but it does not dictate immediate daily price movements. We also need to look at the reporting around gold's share of reserves. By the end of 2025, gold reached 27% of global reserves at market values, higher than the 22% held in U.S. Treasuries. The European Central Bank noted that this was largely due to valuation effects. Because gold prices rose so much in 2025, the value of the gold already in vaults increased mathematically on the balance sheets. If we adjust the math to remove that price spike, using 2023 prices instead, gold's share drops to about 16%. This shows the changing share was driven by price, not a replacement of other assets. Furthermore, gold is not a direct replacement for fiat currency. IMF COFR data, which tracks the global use of the US dollar and other currencies, deliberately excludes monetary gold from its totals. These are two different measures. Gold sits alongside currencies and bonds as a diversifier, but it does not serve as a functional replacement for day-to-day liquidity in the dollar. The clearest way to view the data is through these 5 specific strategies: the builder, accumulator, high share case, stability case, and reduction case. This data reveals a strategic map of individual national priorities, rather than just an indicator for daily spot market direction. For live gold, silver, platinum, and palladium prices, visit METLYZ.com. Historical data only, not a forecast, not investment advice.